previous few sessions that we've had, we dealt with the Unit 4 under Financial Accounting, which talked about the admission of a partner. So now we're moving on to the second phase of the accounting for partnership, which talks about retirement of a partner and death of a partner, as well as dissolution of the partnership firm. So under Unit 5, these are the topics which we're going to be covering: retirement of a partner, under retirement of a partner, change in the profit sharing ratio, and then we're going to talk about the death of a partner. And then after those two, we're going to talk about dissolution of the partnership firm. And under dissolution of partnership firm, we're also going to be dealing with piecemeal distribution. And finally, we're going to talk about the sale of the firm. All right, so firstly, let's deal with the retirement of a partner. So from the word itself, retirement, it means to leave the firm willingly. Okay, so when you're voluntarily leaving the firm, it is termed as retirement. Now, as you've seen in case of the change in the profit sharing ratio, we said that the change in profit sharing ratio could be due to admission of a partner, could be due to the retirement of a partner, could be due to the death of a partner, or could be through the wishes of the existing partners to change their profit sharing ratio. Okay, so let's talk about retirement of a partner and how this affects your profit sharing ratio, how it affects a firm in general. So, retirement of a partner. Now, a partner may retire from the firm for various reasons. He may have a lot of different reasons. It could be personal, or it could even be a part of the professional reasons as well. So, maybe it could be through personal reasons like old age, or maybe it could be professional reasons like better business opportunities, or he may not be in the same mindset, or there may not be mutual understanding between him and the other partners. Okay, there could be many reasons as to why a person may retire from a firm. So the retirement of a partner results in a new partnership altogether. When one partner leaves, the remaining partners will constitute a new partnership firm, although the daily operations of the firm, although the business that is carried out by the firm will not be affected through the exiting or through the retirement of one partner. So according to Section 32, subsection 1 of the Indian Partnership Act, a partner can retire in the following three ways. Firstly, with consent of all of the other partners. So the consent may be either expressed or it may be implied. And secondly, in accordance with an express agreement by the partners. And thirdly, by giving a written notice of intention to retire to all the other partners where the partnership is at will. So there are three ways in which a partner can retire. Firstly, when he himself wishes to retire, he can get the permission from all of the partners. And secondly, when they have entered into an agreement which says that after a certain point of time, this person is going to leave the firm. Okay, so there's an agreement, or there is an express contract between the partners which states that after a certain point of time, he has to retire. And finally, by giving a written notice of intention to retire to all the partners where the partnership is at will. So when there is a partnership which has been created at will and he wishes to retire, he can just give a notice to the other partners and then he can retire after that. Okay, so a partner who cuts his connection off with the firm is called as a retiring partner, or he can also be called as an outgoing partner. And the retirement of a partner tends to lead to reconstitution of the partnership firm as the original agreement between the partners comes to an end. And in this situation, the business may continue with a new agreement with the remaining partners, or the partners may dissolve the firm altogether. It depends upon the remaining partners once one of the partners retires. So when a partner retires, his share in the firm should be correctly ascertained and settled. When a partner retires, whatever amount that he has in a firm, his capital, his drawings, his interest, all of those should be calculated carefully. They should be ascertained carefully, and then they should either be paid off to him or they could be settled in different means. Okay, and now next, what are the effects of the retirement of a partner? So on the retirement of a partner, what are the different aspects that are going to be affected? What are the different things that should be changed? So on the retirement of a partner, the old partnership and a new partnership will be happening. The old partnership will be terminated and a new partnership will be created. The old partnership, let's say it had 3 partners. So when one partner leaves, then the new partnership will consist of 2 partners. Okay, so it'll terminate an existing partnership and it'll create a new partnership altogether. And then Another effect is that there should be an adjustment with regards to undrawn profits and accumulated losses. And after that, there will be revaluation of the different assets and liabilities, and proper adjustments are to be made with that regards. And then the goodwill of the firm also has to be revalued. And at the same time, adjustments are to be made depending upon the wishes of the continuing partners. And then after that, when it comes to retirement of a partner, there will be gaining ratio. Okay, so the partner that is leaving, he'll be giving up his shares, right? If he's giving up his shares, that means the continuing partner's shares are going to be increasing. So the combined shares of the partners will be increased. That means there will be gaining ratio for the continuing partners. And then there is a need also to ascertain and determine the claim of the retiring partner or of the retiring partners. And after that also there will be in some situations, the continuing partners may find it difficult to pay off the entire claim of the retiring partner. They may find it difficult if there's a large sum of money. So they can keep a loan account, they can create a loan account, and as such, they can pay off the partner slowly. Okay? So these are the various effects with regards to retirement of a partner. Then, the accounting treatment that is most important with regards to retirement of a partner is the calculation of the new profit sharing ratio and the gaining ratio. So just like how we've seen that it's important to calculate the new profit sharing ratio in terms of admission of a partner, and at the same time it was also important for us to calculate the gaining ratio and the sacrificing ratio, the same applies in case of the retirement of a partner also. So at the time of the retirement of a partner, the business will continue with the remaining partners. So therefore, the combined shares of the remaining partners will be increased. And the ratio in which the continuing partners acquire the outgoing partner's share is called the gaining ratio. Okay, gaining ratio is the ratio in which continuing partners will be receiving or will be acquiring the outgoing partner's share. So it's called gaining ratio. Why? Because the continuing partners they stand to gain by acquiring the retiring partner's share in the profits. Okay, so they're going to receive the other partner's share of profits. That's why it's termed as the gaining ratio. And the calculation of gaining ratio is necessary, especially when only the retiring partner's share of goodwill or of the reserve is to be adjusted. In some calculations, you'll be seeing only the retiring partner's share is to be calculated. So in those situations, it is extremely necessary to know what the gaining ratio is. And after that, you have the new ratio, which you already know is the new profit sharing ratio, in which the continuing partners are going to share the future profits and losses. And how do we calculate gaining ratio? Gaining ratio will be equal to new share minus old share. So these are common knowledge that a few of us would still remember. In case you don't remember, no problem. Here they are. Gaining ratio is equal to new ratio minus old shares. Okay. And moving on, adjustments with regards to retirement of a partner. So at the time of the retirement of a partner, different adjustments are going to be required. Just like in case of the admission of a partner also, we had various adjustments. We had adjustments with regards to goodwill and then assets and liabilities, right? And then after that, we had to change the balance sheet also. So in case of the retirement of a partner, we have these 5 adjustments. Firstly, adjustment with regards to goodwill. Secondly, adjustment with regard to revaluation of assets and liabilities. Thirdly, adjustment with regards to undistributed profits and losses. Fourthly, adjustment in regard to joint life policy. And fifthly, adjustment in regard to share of profits from the date of the last balance sheet to the date of retirement. Okay, so let's look into these adjustments one by one, starting with goodwill. So firstly, adjustment with regards to goodwill. So at the time of the retirement of a partner, an adjustment will be necessary with respect to goodwill. And the retiring partner is going to be entitled to a specific share of goodwill of the firm because he has worked in the firm. So when he is retiring, he should be receiving some money for the contribution that is made towards the firm. So in the absence of any agreement, goodwill will be distributed in the profit sharing ratio itself. Now, the valuation of goodwill is going to be done on the basis of provisions of the partnership deed as has been provided in the partnership deed. So if the partnership deed is silent, then the valuation should be done in such a manner as must have been agreed upon by the partners. So in case of valuation of goodwill, you've already seen the different methods for valuation of goodwill. You had the average profits method, super profits method, you had the capitalization of goodwill, right? So those different methods can be used in case of valuation of goodwill on the retirement of a partner as well. So there are a few cases with regards to adjustment of goodwill. Firstly, case number 1. When there is no goodwill in the present balance sheet and the goodwill is raised in the books of the firm at full value, but it is immediately written off. So with this regards, under the first case, you have these few journal entries. So the journal entries are, for raising of goodwill, you have goodwill account at full value, it will be debited to all the partners' capital accounts in their old ratio. This is when you're raising goodwill. And when you're writing off goodwill, continuing partners' capital accounts in the new ratio will be debited to goodwill account at full value. This is when no goodwill in the present balance sheet and goodwill is raised in the books of the firm at full value, but it is immediately written off. Okay, same journal entries just like in case of admission. Then you have case number 2. When there is no goodwill in the present balance sheet, but only the retiring partner's share of goodwill is to be adjusted. So in this situation, you have, in this case, the retiring partner's share of goodwill will be raised in the books by crediting the retiring partner only. So you have the first journal entry there for raising retiring partner's share of goodwill, goodwill account, that is the retiring partner's share debited to the retiring partner's capital account. And after that, it will be written off by debiting the remaining partners in the gaining ratio. So you have the second journal entry for writing off goodwill, continuing partners' capital accounts debited to goodwill account. So remember, in this second case, there is no goodwill in the present balance sheet, but only retiring partner's share of goodwill is to be adjusted. So that is why we are raising only the retiring partner's goodwill. We're writing off the remaining amount of goodwill. Okay, we're writing off the remaining amount of goodwill to the remaining partners. Alternatively, you can also create an entry that is a composite entry which says continuing partners' capital accounts in the gaining ratio will be debited to retiring partners' capital account, whatever is the share of the retiring partner's goodwill. Okay, you can create a composite entry which is continuing partners' capital accounts in the gaining ratio debited to retiring partners' capital accounts in the share of the retiring partner. So let's look at a simple question first. A, B, and C are partners sharing profits and losses in the ratio of 4:3:2. B retires and the goodwill is valued at rupees 21,600. No goodwill appears as yet in the books of the firm. Assuming A and C will share profits in the future in the ratio of 5:3, pass entries for goodwill separately under the following conditions. So the first situation is when goodwill account is raised but written off. Second situation, when only B's goodwill account is raised and then written off. And third situation, when only B's share of goodwill is adjusted through the capital account of A and C. So as per the question, it was given to us that there are 3 partners, A, B, and C, and you have the old ratio is 4:3:2, and B will retire and the goodwill will be valued at rupees 21,600, and they've also stated that no goodwill appears as yet in the books of the firm. So assuming that A and C will share profits in the future in the ratio of 5:3, we have to pass journal entries under 3 situations. So the first condition is, let's solve it for the first condition first. When goodwill account is raised but written off. So when goodwill account is raised and then immediately written off, and also when there's no goodwill in the present balance sheet, we have to raise the value of goodwill and then we have to write off the value of goodwill. So for raising the value of goodwill, we have to use the journal entry, goodwill account debited to all partners' capital accounts in the old ratio. And when we are writing it off, only the continuing partners' capital accounts will be debited to the goodwill account at the full value of the goodwill account. This is as per case number 1 that you've seen with regards to adjustment in regard to goodwill. Okay, with the adjustment in regard to goodwill, case number 1 talks about when there is no goodwill in the present balance sheet and goodwill is raised in the books of the firm at full value, but it is immediately written off. So let's write down these journal entries. Goodwill account, as we said, this should be at full value. Okay, so goodwill account debited, full value of goodwill is 21,600. So 21,600 debited to your all the partners' capital accounts. So to all partners in a sense, it should be given to partners A, B, and C. So to A's capital account, and then at the same time to B's capital account, and also to C's capital account. So this will be in the old ratio, which is 4:3:2. So let us divide 21,600 in the ratio of 4:3:2. A should be receiving 9,600 of the goodwill. B should be receiving 7,200, and C is receiving 4,800 of the entire goodwill. Okay, so when you're writing your narration, it should be being goodwill raised in the books at full value, and it should be credited to the partners in the old profit sharing ratio of 4:3:2. Okay, this is the first journal entry with regards to your first situation. So as we've said, we should raise the goodwill, and then we should write off the value of goodwill. So under the first condition, your second journal entry will be towards writing off the value of goodwill. It will be continuing partners account debited to goodwill account. So continuing partners, you have A and C. Partner B is retiring, right? So you have only A's capital account debited to, B's capital account debited, B's capital account debited to goodwill account, So goodwill account, the amount remains the same, 21,600. This is at full value, and when you are giving off the amount of 21,600, the goodwill amount, now you'll be sharing it between A and C in their new profit sharing ratio. New profit sharing ratio 5:3. So let's share that amount between 21,600 between A and C. So 13,500 and rupees 8,100. Okay, this one we're sharing in the new ratio of 5:3. New ratio of 5:3. So the narration for this will be being writing off of goodwill in the books by debiting the remaining partners in their new ratio of 5:3. Write it how you understand it. There's no need for you to write it exactly the way I say it. You can write it just the way you understand it. Okay, so the next situation in the question, it was given to you. The second case is when only B's goodwill account is raised and then written off. When only B's capital account is raised and then will be written off. So under this situation, we have to first calculate the amount of goodwill that is going to be given to B. And then after that, we have to raise that amount of goodwill and then write off that amount of goodwill. So this is for case B. So firstly, calculate the amount of goodwill that should be given to B. So let's make a working note. Open a working note, and you can write it as calculation of B's share of goodwill. Calculation of B's share of goodwill. So total goodwill is equal to rupees 21,600, right? And B's share in the original firm, B's original share in the firm was in the ratio of 4:3:2. So it'll be 3/9, okay, which is 1/3 practically. So B's share is equal to, original goodwill is equal to 21,600. B's share is equal to 3/9 or 1/3. Therefore, B's share of goodwill is equal to 21,600 into 1 divided by 3 is equal to rupees 7,000 200. So we now know how much B's share of goodwill is. So this is the amount we have to raise, and that is the amount we have to write off as well. So you can write down the journal entries when you're raising the goodwill. Goodwill account debited. This is the amount we got from the working note, rupees 7,200 to B's capital account. Okay, rupees 7,200. So you can write down the narration as being B's share of goodwill raised. Okay, being raising of B's share of goodwill. And then after you raise B's share of goodwill, we have to also write it off, and we'll write it off to your continuing partners. So it'll be A's capital account debited and C's capital account debited to goodwill account, rupees 7,200. So it'll be divided in their gaining ratio. So you can also calculate the gaining ratio. You've already seen the formula, what you can use with regards to calculation of the gaining ratio. We saw gaining ratio is equal to new share minus old share. So you can calculate now the gaining ratio. Gaining ratio is equal to new ratio minus old ratio. So in case of A, new ratio minus old ratio. So calculate for A and C accordingly. The old ratio with regards to your partners. Okay, so the old ratio for A was 4/9. And the old ratio for C was 2/9. And the new ratio is 5/8 and 3/8. So this will give you a gaining ratio. It's equal to A is to C is equal to 13 is to 11. Alright, so see and make sure you're getting this gaining ratio, 13 is to 11. And once you're done, we can come back to the journal entry for case B, the second journal entry, where we are going to be distributing this 7,200 value of goodwill of B between A and C in their gaining ratio. So it will come to rupees 3,900 and rupees 3,300. Okay, this is based upon their sacrificing ratio. So it'll be being B's share of goodwill written off by debiting the remaining partners in the gaining ratio. This is as per case number 2. Okay, when there is no goodwill in the present balance sheet, but only retiring partners' share of goodwill is to be adjusted. So we should raise retiring partners' share of goodwill first, and then we should write off the goodwill of your retiring partners. Okay, and moving on, you have the third situation when only B's share of goodwill is adjusted through the capital account of A and C. When you're only adjusting B's share of goodwill through the accounts of A and C, it means B's goodwill is going to be distributed between A and C. So you've already calculated the amount of goodwill for B, right? You saw the calculation of the goodwill. It was rupees 7,200, and you saw the gaining ratio also 13 is to 11, which is the amount that they're sharing between A and C. So A's capital account, this is for the third situation, A's capital account debited and C's capital account debited to B's capital account, when only B's share of goodwill is adjusted through the capital account of A and C. So B's share of goodwill is 7,200, and you already know your gaining ratio. So it'll be adjusted through the capital accounts of the continuing partners who are A and C. And narration, you can write it being B's share of goodwill adjusted through the capital accounts of A and C. Got it? So this is how you're solving question number 1, where we see 3 different cases. Okay, when goodwill is raised but it's written off immediately. Then after that, when only the retiring partner's share of goodwill is raised and then written off. And finally, when the retiring partner's share of goodwill is adjusted directly through the capital account of A and C. Okay. So let's come back to the various adjustments that we're seeing with regards to goodwill when there is retirement of a partner. So we've seen two cases already. Now we'll look at the third case when there is no goodwill in the present balance sheet and adjustment is to be done without opening the goodwill account. So in this situation, we're not opening the goodwill account, so we have to touch only the capital accounts of the partners, the remaining partners and also the retiring partner. So in this case, the continuing partner's capital account will be debited in the gaining ratio and the retiring partner's capital account will be credited with his share of goodwill. So the journal entry we can see there, continuing partner's capital accounts in the gaining ratio debited to retiring partner's capital accounts with the share of goodwill of your retiring partner. So look at a small question. A, B, C, and D are partners in a firm sharing profits in the ratio of 2:2:1:1. On B's retirement, the goodwill of the firm is valued at Rs 90,000. A, C, and D decided to share future profits equally. Pass the necessary journal entry for the treatment of goodwill without opening the goodwill account. So in order to solve this question, firstly, we have to calculate the gaining ratio. Then after we calculate the gaining ratio, we also have to calculate what is B's share in the goodwill of the firm. And then after that, we have to calculate how they are going to be adjusting the share of goodwill in the future of the firm. And then we can move on towards the journal entry for this particular sum. Okay. So firstly, as we said, we should first calculate the gaining ratio. So I have prepared a table. Again, if you wish, you can also use a statement. It doesn't matter, whichever way you find easier, you can use that method itself. So I have prepared the table and you have 5 columns: partners, new ratio, old ratio, sacrifice, gain, and then the gaining ratio. So under the partners column, I'm going to write down the names of the partners A, B, C, and D. Okay, and then under the new ratio, we've already seen the new ratio. In the question, it was given that A, C, and D decided to share profits equally in the future, right? So new ratio will be 1/3, and B is the one who's retiring, so nothing for him. C also 1/3, D also 1/3. And the old ratio you see there, 2:2:1:1. So old ratio 2/6, 2/6, 1/6, and 1/6 respectively. So sacrifice or gain will be new ratio minus old ratio. So in case of A, new ratio minus old ratio is equal to 1/3 minus 2/6, which is actually 1/3 itself when you simplify. So there is 0 or nil sacrifice and gain. And then in case of your retiring partner, he is going to be sacrificing 2/6 of his share. This is sacrifice. And next we have between C and D, 1/3 minus 1/6 is equal to 1/6, which is a gain. And at the same time, it will be the same for this also. 1/3 minus 1/6 is equal to 1/6, which is a gain. Okay, so the retiring partner is sacrificing 2/6 of his share, and this 2/6 of his share will be shared between C and D in their gaining ratio, which is 1/6 and 1/6 respectively. So the gaining ratio is only between C and D. So C is to D is equal to 1:1. The gaining ratio is 1:1. So now we have calculated the gaining ratio. The next step for us is to calculate the goodwill after the retirement of the firm. After the retirement of the partner B. So I have prepared another statement for the calculation of the readjustment of goodwill. The statement, you may prepare it, you may not prepare it, it's up to you. So this will just show how the goodwill will be readjusted after the retirement. So I have prepared here particulars, and then you have the different partners that you have, A, B, C, and D, and the amount in rupees. So firstly, right of goodwill before retirement. So before retirement, they are sharing goodwill in the ratio of 2:1:1. And after retirement, goodwill will be shared equally. So 1:1:1. Okay. So then moving on, we have to also see how much the goodwill is how much is the goodwill shared between the partners before retirement. So before retirement, all the partners are going to be receiving a share in the goodwill. So total goodwill, as per the question, rupees 90,000, divide 90,000 in the old ratio, 2:2:1:1. So as a result, in this situation, partner A is going to be getting 30,000. Partner B also has the same ratio, so rupees 30,000. And partner C and D having the same proportion, 15,000 and 15,000. Okay, so as per the old partnership firms ratio, this is how you're going to be sharing the goodwill. However, in the future, they're saying the goodwill is to be shared after retirement in the new ratio. So in the new ratio, the goodwill is going to be 30,000 for A, for B nothing, for C it'll be rupees 30,000, and for D it'll be also rupees 30,000. Now, I want to see what is the difference between the old ratio, the old share of goodwill and the new share of goodwill. Okay, I want to see what is the difference between the old share of goodwill and the new share of goodwill. So for A first, earlier A was getting 30,000. Okay, earlier A was getting rupees 30,000 and now also he's getting rupees 30,000. So there is no change in goodwill. So I'll write it as nil. And then when it comes to B, earlier he was getting 30,000. Now he's not getting anything. In the new goodwill, in the new firm, he's not getting anything. So there is a loss for B to the extent of rupees 30,000. And then in case of C and D, earlier they were both getting 15,000, but now they're both getting 30,000 each. So that means there is an increase of 15,000 to both C and D. Okay, there is an increase of rupees 15,000 to the goodwills of both C and D. And this particular amount of goodwill, this increase in the goodwill, is the amount that has been sacrificed from the goodwill of partner B. Okay, so this statement will just show you who is receiving how much of the goodwill. And then moving on, finally, let's come to the actual solution. So let's start with the journal entries in the books of the new firm, or you can write in the books of A, C, and D. And then you can write journal entries. So here they're saying we have to pass necessary journal entries for the treatment of goodwill without opening any goodwill account. So without opening a goodwill account, we have to only touch the capital accounts of the partners. We have to only use the capital accounts of the partners. So C's capital account, because A is not getting any of the goodwill, right? A is not going to be getting any of the share of goodwill that was given up by partner B. So only C and D are going to be getting that goodwill. So C's capital account debited, D's capital account debited to B's capital account. So as we've already seen in the previous calculation, B's goodwill is rupees 30,000. So B's goodwill rupees 30,000, and it is being sacrificed for C and D, being given to C and D in this amount, 15,000, 15,000 each. So we can write that in the journal entries, rupees 15,000 and rupees 15,000 for C and D. Okay, so this is the only journal entry under this situation. And your narration can be being the required adjustment for goodwill made through the partners' capital accounts. Okay, being the required adjustment for goodwill made through partners' capital accounts. So these are the three cases so far that I've seen with regards to the adjustment of the goodwill. And we have one more case, and we can see that in your next session.